Good afternoon, everyone. I'm Steve Burness, President and CEO of your Better Business Bureau serving Chicago and Northern Illinois. It's really a great pleasure to have you with us today for one of our most valuable webinars you'll attend this year. The core mission of the BBB is educating and protecting consumers and promoting better businesses. As you know, April is a time we observe both Financial Literacy Month and Money Smart Week in Chicago. Money is one of the top stressors for most Americans, almost every survey, often ranking number one. The BBB and the Financial Planning Association partner to provide you a free downloadable ebook to help you with your financial planning. You can get your copy at bbb.org/Chicago Buzz, and it's also in this presentation. Also with ebook, we are honored to present a powerful webinar with two of the most brightest minds in money management. We're so fortunate today to have nationally syndicated financial expert and best-selling author Terry Savage and Ed Gjertsen, past national president of the Financial Planning Association and founder and CEO of the Engage Wealth Group. So grab your paper, sharpen those pencils, and get ready. We'll have an interactive game that we'll explain in a little bit as well. Again, thank you for the dynamic duo today for being here with us today to help our viewers. And therefore, I'll turn it over to Terry and Ed. Terry?
Oh, well, thank you very much, Steve, for sponsoring this. I'm not going to take up too much time. When you see how the 20 questions works, we're going to have plenty of answers for you. I just wanted to say it's wonderful to see Money Smart Week being extended, even in this virtual era. Ed and I used to come to the Chicago Public Library for a crowd. I hope some of those people found their way onto this webcast. And I would also like to say there's just nobody else I would be comfortable doing this with other than Ed Gjertsen. He's the terrific financial planner, guy you can trust, and he was very, very smart. So we decided this would be a lot of fun to see if we think alike in all the answers. We'll find out. Ed?
Terry, thank you so much. I'm blushing a little bit, but I appreciate those accolades. Financial literacy and education is really, really important to both Terry and I, and that outreach is so important. And coming up with today's idea was literally reaching out to the audience to give us ideas of what is on your mind and what are the top topics. So looking forward to having a good, fun, interactive conversation. And Tom, go ahead and take it away.
Thank you, Ed. Thank you, Terry. It is really such an honor to have this dynamic duel. This is really a power lunch today. So I want to get out of the way. I want to get out of the way fast, but I want to explain what's happening today. Instead of a traditional webinar, we thought we'd bring you something really exciting, a game with 20 questions. It's called Top 20 Money Questions, but we put 30 on there just in case we can get to all 30. Now, you may be asking, why is there a smiley face up here? And that's a great question, because behind 8 of these numbers are a smiley face. And you'll either win the Savage Truth, Terry's latest edition of her famous book, or you'll win a $50 gift card. Now, you're saying, wow, that's got to be complicated and hard. It's actually not. It's really easy. So up in the control panel on your control screen, you're going to see in the upper right your control panel, and there's a question mark there. When you click on that question mark, you can actually ask, hey, I would like Terry and Ed to answer number 28, and type in your name too. And if it's daily double, you'll win. We do want to remind BBB employees are not eligible to win. They value Terry and Ed's expert advice as well as anyone. So again, we're going to have fun. In the background, we have 2 great employees, Diana and Carly will be calling them out as they come through. So all you have to do, go to that question mark and say, my name's Bob Jones. If it's Bob Jones, you can use your real name properly and say, I would like Terry to read number 27 or whatever number you pick. And we'll get started right now. And our president and CEO.
We have no idea. We have no idea. These were questions that got solicited. I don't know how. We have no idea what's where. And we'll alternate, one of us answering first and the other one adding a comment or two.
And Terry, that's a great point to add. We took a lot of the questions that we got from surveys of questions that they wanted to find out from you. So Terry, Ed, don't know what's going to come out of this. And our President and CEO, Steve Burness, I'd like to offer you the honor of picking the first question. Don't forget, you're not eligible.
Oh, man, that's fun. I have Terry's book already. It's a great book. You got to read it. Let's see. I'll start off with this pick number. I love the number 3.
Okay, off we go. And question number 3 has no smiley face on the back, but how much of my income should go toward housing? Again, the question, how much of my income should go toward housing? Great question.
Terry, you want to take that one first?
Sure. You know, there used to be an old rule of thumb and an old rule of thumb that was 25 or 30%. But today, to be honest, a lot of people are spending close to 50% of their income on housing. Now, when you talk about housing, you have to decide, is that my rent or my mortgage payment, or does that include everything related to housing, which has to do maybe with your property taxes if that bill comes separately, your electricity, utilities, if you have a water bill, and so forth. If you add those basic costs of housing up, you can't afford it if it's really over 40, 42% of your net income, because you'll leave money for food and a bunch of other things. So people are straining though today because housing has climbed, the values of not only homes, but the prices of rents. So people are straining and paying upwards toward 50%. That's a recipe for a tight budget. What do you think, Ed?
Yeah, it's great points, Terry. And I think the other thing to kind of consider as well is you've got this upward price pressure, if you would, on rental rates. And now mortgage rates, I believe, just eclipsed 5%. So now going forward, as Terry had mentioned, it's not going to become less expensive. So in order to have good financial sound footing, by putting too much into housing as a higher percentage of your overall net income can create some financial challenges. So just be very careful, as Terry had mentioned, in terms of all of the expenses in terms of your housing. But if you can keep it below 40, even keep it below 35, that's a good thing.
And Carly, we'll check in with you. Would you like to read out one of the questions from one of our viewers? Again, you just type in your name, ask Terry and Ed to answer whatever number you like, and you become qualified to win that daily double.
Sure, Tom. We haven't had any come in yet. However, I do want to remind our BBB staff that they are not eligible for this. So if they're thinking that they can type their name in and pick a number, I know this is going to be fun for everybody, but we're really looking for non-BBB participation for this webinar. So
Hey, Carly, you
want to pick another number? I can
Sure.
pick a number. You do. Cool. I'll pick my favorite number, which is 7.
7, we'll go see if 7 is lucky. And Carly, you're not eligible, but look, it's a smiley face, and you would have.
Woohoo!
Means I'll pull a draft work and I'll give it to the next person submitting a question. How about that? Or not submitting
Perfect.
a number for Terry and Ed to answer. So
Great.
on to question 7 for Ed and Terry. How should I consider, when should I consider taking Social Security? Great question.
go ahead.
Yeah, so you're eligible for Social Security at age 62 if you're a surviving spouse at age 60. And so there's a number of people who are concerned that the Social Security Trust Fund is going to run out of money. And on your Social Security statement, it even says that. But that shouldn't force you or even have you think to take Social Security that much early. Social Security is anti-poverty insurance that was created during the Depression, and that's what it's for. So if you have to take Social Security, I've had a number of people who I know who were unintended retirees during COVID, meaning that they were in their early 60s, waiting to retire and work to their mid to late 60s, and their companies had different plans for them. So some of those folks were forced into taking Social Security early because they were not available to get gainful employment. So when considering Social Security, the guidance that I would give is if you're still working, please do not take it before your full retirement age, which for most people is going to be between 66 and 67. Ultimately, if you take it early, it's very punitive and has permanent reduction in your benefits. So really carefully consider before flipping that switch onto Social Security to make sure it's the right time at the right place in your life.
I'm going to go one step further. I'm really going to go one step farther. Stop worrying about Social Security running out of money. They're going to print the money. Do not take Social Security early, unless it's a dire case. If you do work, if you get a job back or realize Social Security isn't enough, you get penalized very heavily for your income that you earn. But more important, if you will wait after you reach your full retirement age, it is equivalent to, every year you wait is equivalent to getting an 8% increase in your base pay. And not only is that your base monthly check increase, but that means all future inflation adjustments are made on that higher base. So if you can figure out a way not to take Social Security until the last date, which is age 70, if you can use some other income, or better yet, keep working, at least enough. I mean, Social Security, the average benefit this now is $1,500 a month. Probably this audience working all these years, you could get $2,800, $2,900. Maybe there'll be a point where you get $3,000 a month as your base check. It's not going very far. The longer you can delay, the better. So wait, even get an extra 8% base after you reach full retirement age and get your Social Security at age 70.
Great
Next
answer.
question.
It's right there.
Awesome. Thanks, Terry. Tom, we have Joan, who she would like to pick number 30.
All right, Joan, we're going to pick number 30, and regardless of what's on the back of this, if it's a daily double or not, it was not, but we're going to give you the daily double anyhow. And this one says The Savage Truth, the book by Terry Savage, and you'll get a free copy.
Okay. Don't make sure they have your mailing address and your spelling of your name. I'll autograph it and send it to you.
So the question is, can I add my grown children to my bank account? Interesting question.
Terry?
Yeah, you can add anyone to your bank account. That's not a taxable event. So if you want it, but think about this. You might want to add it in terms of joint tenancy with right of survivorship. If you happen to outlive your adult child, you might have or on the account. But just when you put that account in your joint name with your adult daughter or son, think about that, because now it's partly that child's asset. If that child gets divorced, it might be considered part, and you put them on a big CD account, you could run into trouble. There are better ways, in my opinion, if you just want to have someone be able to handle things. And we'll probably get a question on wills, but if you created a revocable living trust and made your son or daughter the successor trustee, acting, if you're unable to act, you've had a stroke, you're in the hospital or whatever it is, that person can automatically have access to the account to spend on you or whatever. So yeah, you can add someone to your account, but just remember that makes them a part owner and vulnerable in lawsuits or divorces or whatever.
Yeah, it's a great question, and it's one that we often talk to clients about, because a client will end up going to a bank or an institution. They'll come back and they'll tell us, hey, I just added my adult child to the account. And I'm like, oh, as a signor? And they're like, oh no, as joint tenant with rights of survivorship. And to Terry's point, that opens up that account potentially to your child's creditors, which is not a good idea. And as Terry had mentioned, if you're worried about what happens to you when you die and I want to have a joint account with your child, think about something called POD, or pay on death, which is almost like a beneficiary designation on that account. It could accomplish the same thing that you're looking at accomplishing in terms of, hey, I want to make sure this money flows down to my child or my children very simply without a whole bunch of legal work. But also remember that by adding anybody to the title of any account, you open yourself up to potential creditors on their side. So be very careful and almost insistent when you're talking to bankers in terms of what you're really looking for, and hopefully they'll be able to guide you through the process.
Great, thank you. I just want to remind everybody on this webinar that you can go to bbb.org/Chicago Buzz and see this webinar later. And you can also go there to download a free financial ebook, which was created with the FBA and the BBB. And we've got some really good ways to walk through some of the terminology, which can be confusing for sure. Carly, what do we got?
Next up is Toby and number 17.
Toby and number 17. Sorry, it's not a daily double, but it's a great question. How do we make a budget while paying off debt?
Wow. Yeah, Terry, I'll take that one. So things are relatively simple, but they're hard. And so what I mean by that is good financial health is relatively simple, right? Save more than you spend, right? That seems very logical, but it's hard to do from times. And at times you end up building up debt, which can hinder you from saving into the future. So the best way to look to pay off debt is by having, I don't like the word budget personally, it reminds me of the word diet. I like the word spending plan, right? So I want to know what's coming in, I want to know what's going out, and I'm going to be on plan as best as we can, knowing quite well that you might have a car repair or home repair or something that all of a sudden throws your spending plan off, and then you come back to plan. But paying off debt is a real critical element because there's a number of different strategies that are out there to pay off debt. But having a spending plan in place and then having a way basically of attacking that debt as fast as you can to pay down those high interest rates potentially is really important. So have that spending plan in place, come up, and maybe you have to cut back on some of the spending in order to pay down that debt, but that's critical in order for you to get good financial footing.
I'm going to give you a simple formula to pay down your credit card debt. Listen carefully. Take this bill, the current bill, look at that minimum monthly payment, whatever it is, $210. Double it, $420. Write that number down, put it on a Post-it on your computer screen if you pay your bills online or on your checkbook. Pay that same amount every single month. Double this first current minimum monthly payment. It'll change over the months. Keep paying that $420. Don't charge another penny, and your credit card balance will be paid off in less than 3 years. If you keep paying the minimums the way the banks calculate that with the interest of about 19.8%, and many people are paying much more, it will take you as long as 30 years to pay off the balance. So when you talk about, as Ed talks about, having a spending plan, there are only two ways to approach this situation. One is figure out a way to earn more money. What are you doing this weekend? There are businesses dying for help. Don't be the person who's sitting in the chair in the restaurant. Be the person who's serving. An extra couple $100 a month could go a long way to paying down your debt. And then do that formula. Double the current minimum monthly payment. Don't charge another penny. Pay the same amount every month. And one other thing, I would suggest you use either Quicken or Mint as a software to help you keep track of what you're spending in each category. I always talk about the fact that if you're on Mint, it's an app for your phone, and you've set up categories for budgeting, and you're out to dinner at the restaurant, you're at the bar, and you say, I'll pay for the drinks, you guys go to the table, and you're going to get a ding from Mint saying, you've just gone over your spending category for entertainment. Don't pay for dinner. So Mint is a great app for that.
That's great. We promised you a power lunch, and we hope you're enjoying it. All you have to do is click that question mark and say, I would like Ed and Terry to answer whatever number is left up on this board. I will tell you a tip. There are more daily doubles in 1 through 20.
All right, let's look at number 24. Clerk would like that one, please.
24, it is not a daily double, but let's go down to the question. Should I lease or buy a car? I've heard that question often.
Very simple. The reason people lease a car is because they can write it off for business. So that's the real reason. I mean, the main reason people lease a car is because they think a lease costs less on a monthly payment basis than the payment for a car. Now, these days, and I just did this as a post on my blog at terrysavage.com, my son was telling me that lease prices are about the same as the purchase price of a car because of the way they're financing them and the stuff that's being thrown in. So from my point of view, and I did used to lease a car when I used it for business, traveling all over, giving speeches and stuff, it's only good if you can write off a portion of your car usage as a business expense. Otherwise, you might as well buy the car, and after 3 years, you'll have something to show for it, a car you can drive for another 5 years. In fact, I am driving the car that came up. I am driving a 2013 Lexus. I always lease them for whatever, that's 2 or 3 years. And I'm still driving the same car. I was only driven by a little old lady, on weekends. So yeah, I'm glad I have that car.
Yeah, the only thing I'll add, and that's great advice, Terry. The only thing I'll add is for my clients who are in their, let's say, late 70s or 80s and they're still driving, And that generation is all about paying for my car and keeping it forever, which sounds great. But if I've got clients who have health issues or cognitive impairment, I ask them not to buy a car. And the reason is for two reasons. I suggest them to lease the car, because if their doctor ends up telling them, you can't drive anymore, someone in the family is going to get a terrific car that has 100 miles on it. The other side is, especially for older Americans, is that the newer cars have the newest, best improvements in safety and such. So the cars today, especially for my older clients, that's one of the things that we go through is we look at buying versus leasing. And to Terry's point, you can figure out the cost for either of those two transactions. But my philosophy has sort of changed over the years, especially with my older clients, when again, we're seeing more and more clients, doctors telling them you can't drive anymore, and there's a brand new car sitting in the garage. So that's only a little bit of a wrinkle that I'll give to the answer in terms of buying versus lease.
Very interesting.
Carly, would you like to tell us who's asking or picking the next number?
Absolutely. Cosmo would like number 5.
Cosmo, number 5. Oh, sorry, not a daily double, but where should I keep my savings accounts is the question.
Oh, I did. So this is chicken money. You know, I created that category of chicken money you cannot afford to lose. We chicken money people are in a big problem right now. We don't have to be a genius to know inflation's eating away at your money at about 8%. The banks are still paying a half of 1%. That's a price you pay for liquidity and safety. If I asked how much money of that you wanted to lose, and you said to me, oh, I'm really comfortable risking it, and I have a long-term horizon, then we might say the stock market or dividend-paying stocks or an equity income mutual fund. But you talked about your savings. Right now, the banks don't have to pay higher rates because they're flooded with money. The Fed is starting to talk about sucking some of that money, liquidity it created, out of the economy. We're seeing inflation, which is all that money racing around. I think you'll see savings rates go up, but I don't think they're going up very quickly. My one suggestion, and you can read the article again at terrysavage.com, put in the word I bonds. Right now, you know, the old Series EE bonds are not a good deal. They have a very low floor and adjustments, but the Series I bonds have a practically non-existent interest rate floor, but they adjust every 6 months to keep up with inflation. Currently, until May 1st, they're paying 7.12%. And May 1st, I think the rate will go even higher. You must hold them for at least a year. If you sell them before 5 years, you lose 3 months interest. You only can buy them through treasurydirect.gov. It's very easy to do, read that column. And the only sad thing about it is you're limited to a maximum of $10,000 in I bonds. Again, you don't buy them at the bank. They're electronic now, and it's very easy. They'll take the money right out of your checking account. You link to it. So that's my best chicken money idea today.
Yeah, the other thing that I'll add, Terry, is for savings accounts, because we have clients who have what they think is, or what others would call, a lot of chicken money, right? So what I tell people is that's your sleep number money. That is what allows you to sleep at night. So whether your friends or colleagues or somebody's like, wait, you have how much sitting in savings? But that's okay because it allows you to sleep. So we always try to direct clients on, number one, FDIC insured bank accounts. And then number two, go look to see who's got the most competitive rate. What you'll find is most money center banks are paying 0.01% on savings accounts. Well, if you go online, you can find plenty of FDIC well-known accounts or well-known institutions that are out there that'll pay 0.5%, if not more. Now, that's a 5,000% increase on your rate of return from going from a bank account paying you 0.01 to 0.5. And you don't have to do anything else other than establish an account at another institution. And then we guide clients on linking your day-to-day checking account with that outside account in case you need funds to come back. So it's a little bit of work, but a lot more interest.
And Ed,
Check out
can you
a website called maxmyinterest.com. They do that for you if you have significant numbers, and they're all FDIC insured accounts. And they do this because the banks don't have to advertise. These are online FDIC insured banks. And it's maxmyinterest.com.
Fabulous advice. Ed, you brought it up first. Can you explain just real quickly what FDIC means?
Federal Deposit Insurance Corporation is the quasi-government entity that guarantees up to $250,000 per individual in case the bank goes out of business. So if you remember the financial crisis back in 2008, I was very impressed with FDIC because a number of local area banks literally went out of business on Friday, opened up on Monday with a brand new name and a brand new bank, but you didn't see any bank runs. You didn't see the bank runs in the pictures that you may have seen from the 30s when institutions were failing and people ran to go take their money out. So FDIC is the insurance company behind the institutions, behind the banks that provide that, that insurance amount of $250,000 per person.
Fabulous. Carly, who's our next number picker?
Next up is Subhesh with number 11.
Number 11. Oh, sorry. No daily doubles. There are a lot of daily doubles.
You hid those. You hid those.
And question 11 is, what is the difference between a will and a living trust?
You take
I'll
that.
go first and you make it practical. Okay. A will is a document you make that goes, I mean, there are a lot of differences, but I'll give you the basics. The will is the document you make while you're alive, and it goes into effect when you die. And you've named an executor or a trustee to distribute your assets. That process of distributing most of your assets goes through probate court, which takes time, and it's very public. A revocable living trust is a trust you create while you're alive, and it could be the Jane and Tom Smith Living Trust, I have the Terry L. Savage Revocable Living Trust, it could be the Smith Family Living Trust. You create the trust while you are alive. You retitle all the assets that are significant, your home, your brokerage account, not your IRA, but your brokerage accounts, your CDs, and in the name of the Smith Family Revocable Living Trust. There is no tax consequence. The trust uses your Social Security number. You buy or sell your home and move on to another home, the same tax laws apply. It's just a convention. However, the difference is that number one, if you're incapacitated, I hate to think about this, but there's a stroke, the successor trustee or your co-trustee, if it's your spouse, takes over automatically. Doesn't have to go to court and say, I need permission to get this savings money out to pay for extra nursing care, because the successor trustee named by the trust takes over. It protects your assets, but not from creditors or anything else. What it does is allow for an automatic transition, but you must retitle the assets that are important in the name of the revocable living trust. At your death, the successor trustee does just what have been done in the will. Distribute your assets. It has nothing to do with taxes, uses your own tax return, but your will would go through probate. This stuff gets distributed. Oh, the successor trustee says, oh, it says right here, the house goes to my daughter. Susan's pearls, it's my trust. My diamond, one of my many diamond engagement rings goes to each of my twin granddaughters, that kind of a thing. So I put all that in there. Those things don't have titles. I listed those instructions, but my house and so forth automatically get distributed. You want a revocable living trust, unless you own nothing practically except a savings account.
Yeah, what I'll add is what Terry had just mentioned in terms of what her granddaughters get. If that was put into a will, remember that's a public document that literally anyone can go to the Cook County courthouse or any county in that, for that sake, and go pull a will, and I can read through Terry's will. And if Terry had mentioned that, oh, by the way, not only do my granddaughters get, this jewelry, but they also get $50,000 a piece, trust me, there are people out there that will find who those daughters are and call them up and try to solicit business to them, because that's what some people do. So in our view, a will and a trust. So you would have both. You would have a will, which is called a pour-over will, along with a revocable living trust. Your financial house is literally built on paper, and that paper foundation is your estate plan. And it's so important that nearly everyone should have a will, at least, and then to Terry's point, a revocable trust, especially if you have property out of the state you reside in. So while everyone could potentially use a trust, you have to remember that wills are a public document and a trust is a private document. That's first and foremost. And as Terry had mentioned in regards to probate, regardless of what any estate planning attorney may direct you, probate is not fun. It's expensive and it takes time. And a trust can help alleviate some of that processes of making sure money is still flowing while you're incapacitated, as Terry mentioned, but also upon death, it allows for very fluid motion of those assets. So really consider both of those, but seek out a qualified estate planning attorney.
That's what I was just going to say.
To help guide you through that process, because there are a number of different attorneys out there that are like, everyone needs an estate plan, right? Everyone needs a trust, and they'll try to sell you on that, which you may or may not need. So find a good, competent estate planning attorney that'll fit your needs.
That was what I was going to add. Let me ask you a question, Ed. So you're a financial planner, and Mr. and Mrs. Smith come to you, and they're really concerned about their 401k rollover and how much they can withdraw. Is that, I know, this is a toss question, I know that one of the things you're going to say to them is, wait, you have 2 adult children, 3 grandchildren, what are you going to do? Have you done this? Do you work with the estate planning attorney that they chose if they don't have one? Can you recommend one? Because that's how I find a lot of people find their estate planning attorneys, through their financial plan.
Yeah, directly. Every competent certified financial planner should have a professional circle. And in our professional circle, we have estate planning attorneys, we have accountants, tax professionals. And so we have a number of estate planning attorneys we work with, and we direct people to based upon the sophistication level. If I've got a client who owns a big company and it's a lot of complicated entities and things like that, we might go to a different law firm than if I just have, Bill and Jane Smith, who are relatively straightforward. They don't need to pay those high prices in terms of an estate plan. They can get it done on a very simple basis. And so that's, again, critically important, to find somebody who's competent, lean on another professional, a financial professional, who can give, that guidance and that recommendation.
That's why I always want to give you a hug. Okay, next question. That's really important stuff, folks. Well, I know we spent a little extra time on this. But do not go to one of those dinners. Do not go download. You don't need an estate planning attorney. Here's the software. By the time they figure out you made a mistake, you won't be around to fix it. You work all your life. You hope there's some left over. Make sure it's done correctly.
And that's common, isn't it? A lot of people get postcards or mailings saying, hey, we got a wonderful dinner for you.
Yeah.
High-end restaurant. So you're saying not such a great idea.
There's no free lunch or dinner.
Yes, and I'll just add 2 cents to that. I often guide my clients. They're like, oh, I got this invitation, and I always want them to send it to me so I can see what's out there. Many of you on this presentation probably have received what I'll call that free dinner, right? It's the lunch or dinner or things like that. Inevitably, they're not being benevolent. They're paying money for you to come eat. They need to sell you something. So always keep that in mind. So whether it's an estate plan, something to deal with insurance or investing, they're always trying to sell you on something, where for Terry and I, this is free. We're not looking for anything in this venue other than giving you good, solid fiduciary advice.
Carly,
one more step. That's the biggest word. Everybody stop and listen to this. So you get to take nothing out of this. No matter who you're dealing with, a broker, an advisor, a planner, or whatever they call themselves, ask, are you a fiduciary? And will you put that in writing? A fiduciary means that they put your interests first. You want a fee-only fiduciary advisor that doesn't charge hidden commissions, that doesn't have excess fees built into the mutual funds that they get a kickback on. You want a fee-only fiduciary financial planner. Ed is the quintessential one. And if you don't know where to go to look for one, I never recommend anything that I have any interest in, but there's a company called wealthramp.com. My good friend, Pam Kruger, we've become good friends, is like the matchmaker queen of putting people together with fee-only fiduciary financial planners that she has carefully vetted. You work so hard for your money. Don't be misguided by titles or this is what we do. Will you put the word fee-only fiduciary in writing? You'll come out way ahead. Okay, please go back to the next question. I apologize.
Fabulous. Thank you, Terry. Carly, who's next?
Next up is Sam with number 28.
Good old number 28.
Daily double.
Somebody doesn't get a daily double next, I'm going to give the, never mind. We're going to give away these daily doubles. So we have 8 of them.
Tom, are you sure you put on 8 smiley faces? Come on.
Unless the stickies fell off the board. Number 28, best lenders to use to finance a house, and is FHA a good option?
Wow.
Go ahead.
Okay, you want me to take that one? So, so in our circle, we have a number of banks and mortgage companies that we work with, and I always guide individuals. What you're looking for is the most competitive rate. And it's not only just the interest rate, but it's also the closing costs and any kind of hidden points that might be embedded within that mortgage. We have refinanced, not us personally, but we have directed clients to refinance their mortgages over the past 3 years because interest rates are at historic lows. And when we talk to people out in the community, what we find is some of the more advertised, if you would, that are national TV, some of those companies were literally kind of embedding points to lower the rate of the mortgage. And our clients were not aware of that. They weren't aware that they were actually paying higher upfront costs to get a rate a little bit lower than what you would get at another institution. And so not good, bad, or indifferent, but that's not the way that we do things. We like transparency. So if you're out looking at a property and you're looking at a mortgage, A, go get pre-approved, very helpful. But B, use your competitive spirit and make sure that you're negotiating between 2 or 3 different entities to make sure you are getting the best deal. Because remember, if you lock into a 30-year mortgage at a rate that's 0.5% higher than what you could normally get, think about all that added interest expense that you're going to be paying over the life of the mortgage if you just would have been a little bit more diligent up front.
You asked for some, I only know what I know, and I don't direct people to too many places. But for example, Wintrust is our sponsor at WGN, the business lunch, and every time I mention mortgages, I get a call from Ed Waymer, the CEO, saying, why didn't you tell them that we are out there trying to get your mortgage? So here's a free commercial for Ed Waymer at Wintrust. The other one is guaranteed rate. One of their top brokers is Leslie Struthers, who's been my kind of go-to person for getting, when I need a quick call, what are the rates now, what are you doing? So Leslie at rate.com is who I call for mortgages. You don't have to use my name, I get nothing out of that. The other thing is, if you have a military service and you know somebody who's really struggling, these days, a lot of homes are going for above the appraisal rate, but if you can get a VA loan with 0% down, you might take advantage of that program, even though you might have to put up money if you're paying up for the home if it doesn't appraise at the market price you're trying to pay. So good question. Do your homework. I think that's right. You have to. It's not wrong to work with 2 mortgage companies at once and find out what the points and the fees are as well as the rate, and then how long the lock is. Rates are going up.
Yeah, and I just want to add something what Terry had mentioned. That's critically important because most mortgage companies will lock in the rate that they mentioned to you for a certain period of time, 60 days, 90 days, whatever it is. And you have to be very diligent of making sure that if the company is looking for information from you, like a 2021 tax return, make sure you are on top of the documentation need because it's a lot and you don't want to lose that lock in this rising interest rate environment. That was a great point, Terry.
Carly, what's next?
Next up is Toby. Going to try one more time. Let's try number 22.
All right, let's try it. Daily double. Congratulations, Toby. Nicely done. You will receive the Savage Truth, Terry's latest best-selling, amazing book, which I still have the original 1 and 2, and worn out and yellow stickies all over it. I can highly recommend that. So that is a lucky question. Let's see what it says. And Terry and Ed do not know what's going to be asked of them as part of this gamification of a webinar, and I hope everybody's having fun. I know you're looking fun. Should I sign up for Medicare if I'm still working?
Terry, you want to take that?
Yeah, well, there are a lot of contingencies here. First of all, you get Medicare Part A. Second of all, a lot depends on whether you work for a company with 20 or more employees. If they give you insurance, then you can delay taking Medicare Part B and your supplement. But if you work for a smaller business, there's a weird thing. You have to sign up for Medicare at 65 because if they are a small company, Medicare becomes the primary payer. So this is a tricky question to answer. In general, if you're working for a big company, sign up for Medicare, get Part A, show them that you have comparable coverage, and then it's taken out of your paycheck. It's probably going to be a little less expensive, maybe even, because you're working. And don't forget, by the way, if you're signing up for Medicare Part B, you hear that Medicare Part B premiums have gone up a little bit. If you're still working full-time and you're getting a paycheck, your premiums could be over $500 a month for Medicare Part B. And then you'll need the Part D, the drug supplement too. So check with your employer to see if you're required to sign up for Medicare Part B, even though you're 65 and still covered.
Yeah, Terry brings up an excellent point about just how complicated Medicare is. So back in the day, I've been doing this almost 30 years. Medicare was really straightforward. You sign up, you got it, you go. It is so confusing today, so much so that I had mentioned our professional circle earlier, that we have a couple of Medicare specialists that we refer business to because it is that complicated. So one of the things that Terry said that oftentimes some of my small business owners are surprised, I'm like, no, you can't be on your plan, you got to go to Medicare. And what you have to remember is Medicare is what's known as means tested, which means that the more money you make, and I think Terry had alluded to this, the more money in premiums you have to pay. So the average rank and file person pays, I think it's like $140 a month for Part B, if you would. That number can be almost triple if you're making enough money. I think it's over $400,000. So where this impacts people is retirees. When we have retirees and they start taking the required minimum distribution and they have a pension and things like that, we're always thinking about what are the implications not only for taxes, but Medicare. So remind yourself 3 months before you turn 65, reach out to Medicare and try to figure it out. Reach out to your HR department to figure out what you need to do, because if you don't do the right things with Medicare, they're going to penalize you in terms of premiums. You want to make sure you dot the I's and cross the T's, which again, back in the day was easy. Today is much more complicated. So make sure you get all the information needed to answer that question more thoroughly.
And 2 quick things about that. There is a website, pardon me, this is all I know, 65 Incorporated, number 65incorporated.com. It'll cost you something, but they will consult with you in advance on what's the best way to go about dealing with Medicare. And it could save you a fortune over your lifetime if you do it right, or cost you more if you do it wrong. So that's a place to reach out. But I'm going to do a column. I do it every year in October, November. When sign up is, remind me to call you and get some of your experts on. And the other thing I just want to, not time for this, we have time yet. Do not sign up for Medicare Advantage or fall for those TV commercials that say, you may be entitled to a lot of stuff. Don't you have Medicare Part C? Look, Medicare Advantage is an all-in-one plan. You don't need the supplement, you don't need the drug plan, but it is managed care. And you are limited to the hospitals and docs that are in that plan. If you don't get sick, your low premiums or non-existent premiums are no big, you'll think, oh, that's great. If you get sick and you want to go to the best cancer specialist or the best MRI place or the whatever, you are going to find yourself paying like crazy, and all those years of low or zero premiums are going to be gone by the wayside just when you really need care. Just be very careful about sucked into, Joe Namath is doing commercials, and how do you think they pay him? They pay him because they're making money because they limit your access to care. Beware of Medicare Advantage, Medicare Part C. Sorry, just had to throw that in.
No, it's all good. And that's the guidance we give clients, is that if you think you're going to be healthy, and we never know what tomorrow is going to bring, Medicare Advantage is great, to Terry's point, is if you're healthy, you don't have any claims. But if you get sick and if you need hospitalization and specialists, Medicare Advantage is no bargain.
Fabulous info. Carly, what do we got coming our way next? And I want to remind latecomers to the webinar, if you go to your control panel and you click on that little question mark, all you have to do is give your name and say the number question that you would like Terry and to answer, and you could be one of our daily double winners. We still have many left. Carly?
We do. We only have 2 winners so far. So let's see. Subhash wants to try one more time with lucky number 13.
Oh, lucky
I was
number.
wondering there. 13. No, wrong one. Wrong one. 13.
No, 13, Tom.
I give him that. Tell him.
Tom.
I would give it to him, but he doesn't need it because he won the daily double.
Yay.
Tell no one that there's a daily double behind 18. That's got to stay between the three of us.
There'll be a race to the question panel.
Why are my stock funds and my bond funds going down in price at the same time?
Yeah, go ahead.
I'll tell you, stock funds are going down because the market's been going down because it's scared about what's going on in the world. You don't need that answer. But here's what most people don't know. And I will tell you this, bonds at this juncture are riskier than stocks. And here's why. And I'm not just talking about, junk bonds or questionable bonds or whatever. AAA bonds of corporations and US government bonds. When interest rates go up, bond prices fall. You bought $1,000 AAA rated US government 20-year bond yielding 2.5% a year ago or so. You know they're going to pay you. It's not a default risk. But now let's say we have inflation and interest rates go up. Next year, the government's going to be selling 20-year bonds at 3.5% or 4 or 5 or 10. I'm not predicting 10%, but could happen. Who's going to give you $1,000 for your old 2.5% bond that has 27 years left to go? When they could, $1,000 could buy them a 7% bond, same quality. So they're going to say to you, you want to sell your bond? It's only got a 2.5% coupon. I'll give you $720. When interest rates go up, bond prices go down. Now you're going to say, well, it's still a good bond. I'm still collecting interest. I'm not going to sell it. Yeah, but you're penalized because you're only collecting 2.5% interest when someone with cash who waited till interest rates peaked at 8, 7, 9, whatever it is percent, gets to earn that interest rate for the next 20 years. So the answer is only buy bonds when interest rates are at their peak. No, of course we don't know that. Just like we don't know when the stock market's at the bottom. But right now, if you own bonds, and we know the interest rates are going up because the Fed has told us interest rates are going up, your bond prices are going to fall. If you own a bond fund and it was $18.20 a share, don't be surprised. It's now at $16.12 a share. Because when interest rates go up, bond prices go down. And anybody who says, okay, you're perfectly positioned, you've got 60% stocks and 40% bonds, means you've got 100% risk. Where's your chicken money? Which is losing to inflation, yes, but is not going to come back on a statement to you saying you used to have $250,000, now you only have $219,000. You still have $250,000. Is that's I have a bug on this. You don't get this, go to terrysavage.com. Just put the word bonds in the search bar for my columns, and that explanation is there. It's more slowly. But bonds are dangerous. You can lose money in them, not because they default, because prices go down when rates go up.
And what I often like to tell people, it's almost like the playground teeter-totter seesaw, right? When interest rates go up, prices go down, you can't break the seesaw. Bonds are priced in a mathematical formula that is pretty straightforward. And so basically what's happening is most of you probably heard of diversification, which means that, hey, if I buy stocks and I buy bonds, one will offset the other, right? In terms of if bond prices rise, stocks go down and vice versa. Well, there are certain elements in the economic cycle, this being one of them, where the Federal Reserve is targeting higher interest rates. And because they're targeting higher interest rates to help stem inflation, to help slow the economy, well, again, those rising interest rates affect bond prices. But while it also affects stock prices, is because investors are thinking, oh, the Federal Reserve is raising interest rates, the economy is going to slow, there's going to have lower profits, and so on and so forth. So what we've been telling clients is, we've been telling them for months, this is what's happening. You're going to lose money in stocks and bonds, and it's okay. And the reason it's okay is because this is the natural economic cycle. There's nothing magical about what's happening now. So ultimately, to Terry's point, is that bonds performed, even high quality bonds performed worse than the stock market in the first quarter. So when you open up your March statements, and even it's going to be your June statements, don't be surprised if you see lower levels. And if you are surprised, you need to talk to your advisor.
Yeah, and your advisor should have been warning you, just like you have. Now look, what else could you do? I mean, 22 people went, well, wait, stocks are bad, bonds are bad, rates are going up. They're not going up on my CDs because the banks don't need the money. What else could I do? Well, there's commodity exchange traded funds. Commodities have had a rip-roaring thing. It's going to continue with food prices because of Ukraine and they can't export whatever wheat they will be able to harvest. Those are very volatile and speculative investments, but commodities. Even gold is finally making a run toward 2000. It was up a little higher, and I think it's about 1970 today. You can diversify your portfolio, but real estate investment trust, but who wants to own an office building real estate investment trust? Not Sam Zell. He sold all his a bunch of years ago. Okay, but how about warehouses? That's the hottest thing in the world, and they give you a yield. So there are, you do have to do a little work. You can buy these in the form of mutual funds. You can buy Treasury inflation protected bonds that adjust, but you don't want to buy them in your own account, only in a retirement account, because otherwise every year you're going to pay taxes on the unrealized appreciation. So what I'm trying to say is we are at a no good alternatives moment, but you should understand you're going to lose money in your CDs because you can't, we showed you how to get a little 0.5% more interest, but it's not keeping up with inflation. Stocks, big debate out there. Is the market going up? Because stocks have, over the long run, always beat inflation. Yeah, but in the interim, there could be bear markets. 1970, the Dow in 1972 was over 1,000. It slipped below 1,000 to a low of 570.01. That was when the options exchange started. I was there. And it stayed below 800 till 1982. You had a decade of stocks doing nothing during the biggest growth period of inflation. Then afterwards, it caught up a lot, and there's never been a 20-year period where stocks have failed to beat inflation, according to Ibbotson. You use those charts too. So yeah, we're at a point right now where, though, we've had 3 years of outperforming the historic averages. The average return 10%, the last 3 years 17% for the S&P. So stocks seem risky, rates are going up, bonds are risky, cash is risky because it's being eaten away by inflation. Gold, wasn't that supposed to take care of everything? I still have my fingers crossed that it will, because that's my gold and energy are my hedges against a moment like this, and they're not doing much. So, and yet, yes, okay, let's do it. I don't know if it's a question on the board. Someone says, well, Bitcoin's got to do it, right? Not so. Bitcoin was at 67,000 last year, last spring, I think about this time. It's around 40, 41,000 today. And the government's figured out how to grab all those frauds, Bitcoin, and get them back, so it's not so secret. So no good alternatives. It's not you, it's the world. Everybody's trying to figure it out.
And just to add one more element to that, Terry, that's where a financial plan comes into play.
Yes.
You don't want to have a fire drill in the middle of a fire, right? So you don't want to be thinking about, oh, now what do I do with my portfolio given the world is in a little bit of chaos. So that's where sort of forward thinking in terms of, well, this is what the assets are supposed to do to support my plan, and my plan is for X amount of years. That's the important part behind a financial plan. So when these times do occur, and they're going to occur not only now but also in the future, you fall back to the financial plan to be like, okay, I'm still on my path. I'm still heading in this direction, and that's important. So you're not making a bad, ill-informed decision when people are panicking at their most.
Another giant hug. That's the hope. You just heard that nugget. I mean, if anybody's listening to this in the replay, rewind and hear that again. That's the point of having a financial plan, and a financial planner whom you can trust, who's smart, and who will be there for you, who's not hiding under his or her desk when the world's falling apart, but who says, no, just be calm. The world isn't ending. Stick with it.
Thanks.
Hey, Tom, I might have missed number 13 and what the prize was. I just want to make sure we get that right. Will you read that off again, please?
I will indeed. And number 13 is The Savage Truth from Terry Savage.
All right. All right, next up is Rolanda with number 2. Let's see what we've got.
Number 2. No daily double, I'm sorry to say. We'll figure out a way to hand these out as we go along. Number 2 is, what is a credit report? Do I need to review it? And should I freeze my credit? Great question.
Well, Terry, you want to take that?
I'll do it quickly because I've monopolized the time on that last one, but your credit report is generated by the things your creditors say about you, the card companies, your mortgage payments, and so forth. They get collated and put into a report. Three bureaus, TransUnion, Equifax, and Experian, issue these reports. You should go online, but only to annualcreditreport.com. There are all kinds of free credit report, this and that. Annualcreditreport.com gives you links to all three bureaus. You do not need to sign up for a monitoring service or anything else. Get your credit report from one of the three bureaus tomorrow and wait a few months and get a report from the other. But they mostly say the same things. Not to be confused. Wait, and while you're at this credit this report, there is no reason not to freeze your credit. It's free. Unless you're out shopping for a car, buying life insurance, going to apply for a new job, in which case they all pull your credit report. Freeze your credit report. It keeps anybody from opening new accounts. You have a PIN. You can always lift it if you decide to now go and apply for a new credit card. So while you're there, get your credit report and freeze it at all three bureaus. It's free. Don't lose track of your PIN. Your credit score is something else. You can get that. Most banks now give it to you. You can go to creditkarma.com and sign up for your credit score. There are a bunch of different scores, but they're all about the same, and they should be in the range of, I hope all of us have it in the range of 700 to 850 is the top percent. And it's generated from the information. And things like, you paid off the balance on your credit card. I get a note from Credit Karma. Your score went up. Why? Oh, because it was time to pay off my balance on my credit card. So score is important. You get that separately. Discover gives it to you free. Chase gives it to you free now. Creditkarma.com. Why they want to give you suggestions for cheaper credit cards. So they've got your name now. But your credit report, you should read thoroughly. And what, by the way, are you looking for? Inquiries that you did not start. Okay, someone else trying to get a mortgage on using your social security number, something like that. Freeze your credit report. That can't happen then.
So two things I'll add real quick. We always encourage people to go get their credit report. And as Terry had mentioned, annualcreditreport.com, you can pull one down every 4 months. You can get a whole year of just your own kind of review. Pay attention to address history. If I'm trying to steal from you, if I'm trying to get credit in your name, I'm not going to use your address. I'm going to find a PO box or something else. So when you pull your credit report, the first thing that you're looking for are addresses that you are not familiar with. And then go through and look at all the different credit cards that you may have outstanding or all different kind of loans that you have outstanding to make sure that you recognize those. So that's first and foremost. And the only other thing that I'm going to add is Terry had mentioned the FICO score, right? Or credit score. There's like an advantage score, I think is the new one. Please don't pay to go get your FICO score. As Terry had mentioned, most major credit card companies are now offering your FICO score for free. And she had mentioned Credit Karma, which we like to use as well from that standpoint. So don't pay for your FICO score because you can most likely get it for free.
And your credit report as well, free. You do not have to sign up for those watches. As long as you've frozen your credit, nobody can open new stuff. Just keep checking back to your credit report.
Terry, Ed, I know we're pushing up on our 1 hour mark. Do you want to take another question or should we wrap?
Oh, yeah, we need someone's got to pull a daily.
We've got two more. We've got two more.
All right, do those two.
Let's try it. Lena with number 14.
Lena, number 14, I'm going to announce this ahead of time. You won a daily double regardless. So.
No matter what.
And she would have won anyhow. Did you say 14, Carly?
1-4.
Yeah.
Yes, 1-4.
Well, I'm off by 1 row, but you won a daily. 14, we're going to give you a $50 gift card. How about that, Carly? So
I think that sounds fabulous.
What is the required minimum distribution and what can I do with it?
Go ahead.
Yeah. So if you have a traditional IRA or a 401k, at the age of 72, the IRS or the Treasury makes you take money out based upon a certain percentage of your age. Every year you get older, you have to take out a higher percentage. It's pretty straightforward, but it's required and you can't miss that. If you fail to take your required minimum distribution after age 72, there is a 50% penalty on what you should have taken out. So pay attention to how much money you have to take out for the year. And so every year, if you have a brokerage statement, most firms are pretty good at showing you what it is. But where we find people having problems, if you've got multiple IRAs in multiple places, you've got a bank CD that's an IRA, you've got a brokerage account and something else, you have to remember you need to take the aggregate of all your IRAs to figure out what your overall required minimum distribution is. And as far as what you do with it, we have clients all over the spectrum. We have clients who are like, I don't need it, pay it to me in December, just so we take it out for the year. I've got clients who like to receive their required minimum distributions around property tax times because it helps with that. And then we've got clients who take it on a monthly basis because of the fact that it helps supplement their income. So required minimum distributions, and then we have folks who don't need it at all, and you can give it away. You can do what's known as a qualified distribution directly out of your IRA to a charity. So if you're in a high income tax bracket and you don't need your RMD, think about using one of the qualified distributions directly to a charity, and you don't have to worry about itemizing that on your tax return. You're just giving that money away to charity. It's another way of saving some taxes.
Got it. Perfect. Oh, they're talking about maybe raising age 75. The government wants its money. The whole point is they let you grow it tax-free, a deferred, and now they want you to take it out and pay them, except if it's a Roth, which is another subject. No RMDs. Roths.
Okay, final question.
Final one is Sam, number 8.
Sam, number 8. We are automatically making this a daily topic. We will give Sam number 8, The Savage Truth by Terry Savage. And question 8 is, how much money should I have in my emergency fund? Great question to wrap this with.
Oh, this is Terry's chicken money. It's all yours, Terry.
This is, there's an old saying, sell down to the sleeping point. It's different for everyone. It depends on your circumstances, depends on your age, it depends on your own personal risk tolerance. I got laughed at a lot for my chicken money in 2000. My son, Mom, you got to get in these .coms. I said, you lose your money. I've already been through it in the 70s. It belongs in treasury bills, treasurydirect.gov. They don't pay anything, but you don't pay state income taxes on it. If you are awake, and here's how much is enough. If you are awake in the middle of the night, worrying, sell down to the sleeping point, put it in chicken money and say, that's it. Self-discipline is the essence of all decision making. The hardest thing to ride out is not a bear market. I think in my history, the hardest thing to ride out is having money on the side that you could have done this with or should have done that with. And I come back to this whole point. I sleep at night. It's enough. Is it a year? If you're younger, maybe, and you don't have a lot of responsibilities, is it 2? Is it 3 years of living expenses? Is it the knowledge, by the way, that you have an income coming in from Social Security? It'll never be enough, although for 40% of the Social Security recipients, it has to be enough. That's what they live on. Is it your pension? Is it your set distributions from something that you've created? Whatever it is and however you structure it, it lets you sleep. That much is enough for safety. Ed?
Yeah, this is one of the more trickier questions that were asked for clients, and it comes down to, Terry, what you said. And again, I borrow it from the bed company. It's your sleep number. What allows you to sleep at night? What allows you to be like, you know what, I'm okay, because the markets can do what they do. My bond portfolio, my stock portfolio, it's going up and down, but I know I have enough cash reserves to cover X. And that can be anything. If you're in a job that you're getting a paycheck twice a month, right? So that's one thing. But if you're in sales and you earn a commission and your checks are far in between, you might need a bigger emergency fund to kind of gap you through those periods of time. So as Terry had alluded to, it is really personal in terms of that. Oftentimes we hear of things, well, 3 to 6 months worth of expenses. Well, that's great unless you lose your job and it's difficult to find a new job or something else comes about. So it's okay to have a lot of chicken money sitting around, like we had alluded to earlier. Make sure you're getting a high rate of interest, relatively speaking, FDIC, but don't be dissuaded from others who think you have too much money sitting on the sidelines, because that's okay. I'm giving you permission. It's okay because it allows you to sleep at night.
Exactly. Another big hug. Hugs out there for joining us today. I'll let Tom and Steve take it away. But Ed, thank you for asking me to be part of this. I know you do so much with the Better Business Bureau and with Money Smart Week. We appreciate the Better Business Bureau, and we appreciate all of you for taking the time to join us.
Absolutely.
Ed, I can't thank you enough on behalf of all of our viewers, who everyone's time is valuable. And when you attend one of these, you hope to get a little nugget to take away. And I hope other people feel like I did. You didn't get a nugget, you stumbled into a gold mine. This has just been fabulous information. We're so proud to present this and so grateful for both of you for giving up your time. I want to remind everybody you can review this webinar and also get a free download of our ebook, and that's at bbb.org/ChicagoBuzz. That's bbb.org/ChicagoBuzz. And I believe everyone will get a link to the ebook who signed up for this registration. Carly, just to wrap this up real quick, because I know this can now be edited afterwards. Carly, how many daily doubles did we not give away?
We have 3 that are still on that board somewhere.
Okay, and with Terry and Ed's blessing, why don't we give the remaining 3 either $50 gift cards or Terry Savage, the Savage Truth book, to the first 3 people who fill out the survey after this. Does that sound like
Perfect. That's perfect.
Brilliant.
Be sure, Carly, be sure to get names, correct spelling, and mailing address.
Got
So
it.
I can get those books out within the next couple of weeks, okay?
Absolutely.
Perfect.
Thank you so much, and thank you for everyone for attending. And this ends our webinar today.
Thanks, everyone.
Thanks, everybody.